Whether you're brand new to trading or you've been in the markets for a while, mastering candles and market structure is the foundation to being a profitable trader. In this series, I'm going to break down step by step exactly how I trade and to teach you how to read the markets with confidence. Welcome to episode 1 of this masterclass. Over the next few videos, I'm going to walk you through the skills you actually need to understand these markets. This is not just by following indicators, this is learning how to read price action. By the end of this series, you'll be able to read price action, spot any high probability trades, and to trade with confidence no matter the market condition. Today we're starting out with the very foundation of this, reading candles, understanding market structure, and the 3 ways the market moves. What is a candle? So for a bullish candle, that's a green candle, and a bearish candle is a red candle. The opening of the candle for a bullish candle is the bottom of a green candle. So right here would be your opening of your bullish candle, and your bearish is your opening for the candle is at the top of it. So that means that the closing price is below the opening, and here the closing price is above the opening. That's all it is to a candle. So let's take another example. Your closing price is below its opening. That's why it's a bullish candle. Vice versa. With the green candle, closing price is above. Then the wick tells everything that you need to know. Either if it's a rejection or if there's no wick and there's strong displacements. We have a top rejection wick, so that means that price did not want to go up there. Oh, but Brennan, there's wicks all over here. Yeah, but is that liquidity? Is that the higher high? Is that the lower low? Right here, for example. This is your rejection block because price wicked down, didn't like this area, shot up. That's something you could use for the future. Now here's how you know you're in a good area, because price wicked here, and then we have a rejection zone right here. This is the basic anatomy of a candle. Each candle tells a story. The body shows where the price is opened and closed. The wick shows the highs and the lows that have been reached during that period. A green candle means price has closed above the position it opened, vice versa with a red candle. Wicks are very important. Long wicks show rejection. Buyers or sellers try to push price but fail. That rejection often tells us when the market's going to reverse or not. Next is the size of the candle. A large candle often shows very strong momentum towards either or side. Small bodies, often known as dojis, that's an indecision candle. That means the market doesn't know where it's quite going yet. No single candle goes anywhere without giving context. You have to look at the past, look where the candles came from, and it tells you a story. Candle form patterns, and patterns form market structure, which we go on to next. Market structure, or market structure, which is it's a bunch of candles forming patterns. So for a downtrend, it would be lower highs, lower lows. So let's go on the 5 minutes so it's easier. Higher low, and then a higher high. And then continuing on. Higher low, higher high, higher low, higher high. And then we could break past that. Higher high, then break through, and then get a lower low. And we'll get a lower high, then a lower low. Then we'll get a lower high, and then a lower low. Then we'll get a breakthrough. And in simple words, market structure is simply how price moves over time. There's higher highs and higher lows, that's an uptrend. Then there's lower lows and lower highs, that's a downtrend. Then there's accumulation, which is consolidation, where the candles are not going anywhere. Why does market structure matter? It teaches you on how to trade. You need to learn to naturally align yourself with the market's flow. Market structure is one of the most important things that you can learn because it's going to teach you when to get in a trade and when not to. It'll also teach you which direction to get into that trade as well. Then there's market structure breaks or shifts. That's just a break of a previous high or a previous low showing strong momentum towards vice versa side. That's usually where high probability setups occur. That could also lead to liquidity sweeps. The market often pushes past previous highs and previous lows. This is called grabbing liquidity. It could often show signs of reversals or continuations. That is something we'll dive deeper later in this series. The 3 ways that the market moves. This is probably the most important thing that you need to learn. Price moves in 3 ways. These are the 3 ways that price moves. So first we have accumulation. That's like a consolidation area. Then we have manipulation, where price wicks up, tricks traders into thinking that price is going to go one way and then it actually reverse, which comes to the distribution. The distribution is the real move that you want to get in every single time. This is where you make the money. Accumulation, that is consolidation. Price chops in a consolidation. The next thing that happens that price does is manipulation, where price traps traders' orders. Price often tricks traders into going into these areas. This is called liquidity sweeps or traps, where your stops are being hunted and grabbing more liquidity, or known as money. Then the final area where you want to get in your trades is distribution. This is where price is finally having the effects of liquidity sweeps and creating the new trend. Every single one of your trades happens in one of these areas. areas. You're either in the consolidation, you're either getting trapped, or you're either jumping into the trend. Identifying which one you're in is a step towards a brand new strategy and a brand new trader. Now that you understand how to read market structure and candles, the next step is knowing when to actually get in and trade and which direction you're going to. That leads to episode 2, where we're going to break down liquidity, where you're going to get trapped and when you're not going to get trapped, and overall starting on our confluences. Now, if you found this video helpful, please subscribe and comment down below what helps you the most. That way I know and I can teach you on how to do better. Thank you all. I love you. God bless. Have a great day.